Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. In this video, we're going to focus on the S&P 500, but we're going to take a look at the two most important charts to follow if you're trading equities, and that is the US dollar currency index and the 10-year yield, because if you know where these two charts are going, you'll have a very good idea of where equities are going next. Now, if you are new here, make sure to smash that subscribe button because we make these videos multiple times a week, teaching you how to navigate these crazy markets every step of the way. Now, without further ado, let's get right into it. All right, so we're going to first begin with a quick overview of what's happening on the S&P 500. We've got the same technical structure we've been looking at for the past few weeks right now with that big breakout here. It doesn't show on this chart. This is a bull market trend line we've been looking at for quite a while, corresponding to this chart here, this bull market trend line that was broken here in March 2021, and the markets have been just relentless ever since this breakout here. So still a very bullish technical structure here, no breakdowns, significant higher lows, significant higher highs. The trend remains up, so nothing much to add in terms of the technical structure here, just that we're testing resistance right now. So if you're looking to go long on the S&P 500, this may not be the best area to be entering. Right, you want to be entering after corrections like the one we had right here, testing that level of support, although that was a very quick correction and a quick snapback, not even testing this line of support here. That's what I mean when the markets are relentless. They're not even coming back to test objective support levels. That's the type of environment that creates FOMO, that creates blow off top moves. So not particularly healthy market action, but extremely bullish nonetheless. So not an objective area to enter right here. We're at resistance. Now, does that mean that the markets are going to correct from current levels? No, right? In fact, I think the markets are heading higher over the next few weeks. Now, what's going to happen over the next few days? That's impossible to predict. What we're trying to figure out is the larger trends in price, not the day-to-day price action. So let's take a look at those charts that are going to help us figure out where the markets are heading over the next few weeks. And the first one is the US dollar currency index, right? So this is the DXY. This is a weekly chart of the DXY. And I want to first quickly discuss why this is such an important chart, looking at the long-term relationship between the US dollar and the S&P 500. Now, I'm going to put a few red boxes here in periods where the US dollar is strong. So when the DXY is rising, I'm putting red boxes here, very strong trends in the dollar. Right here, another red box, and I can put another one in this period right here. So that's 5 red boxes that define the periods where the US dollar was strong over the past decade, ever since 2008. And on this chart, we're going to add the S&P 500. So on this chart, I'm going to highlight a few red boxes in periods where the US dollar was strong. So big rallies in the US dollar here in 2008. We had a big rally, 2009, big rally. Same thing here in 2011. Then between 2014 and 2016, you had a big period with a strong dollar here. Then again in 2018. Big strong dollar here. So we're going to add the S&P 500 on top of this chart, and it's going to highlight exactly what type of relationship a strong dollar has with the stock market, right? At least over the past decade, dating back to 2008. So I've added the S&P 500 here in blue, and let's expand these red boxes just to show you what periods in the stock market these strong dollar periods correspond to. And each of them, with almost no exception, right? In 2008, big correction in 2010, same thing in 2011, same thing in 2015, and again in 2019 here, this huge period of consolidation with the repo crisis and then the COVID crisis. These were strong dollar periods. So that highlights the massive impact that the US dollar has on the S&P 500. So that's why we're going to take a look at that in detail in this video. Where is the dollar going next? Are we going to see another strong dollar period where we could see a market correction here? Or is the dollar going to be weak and push the markets even higher? So if you're looking for a large correction in the markets, you're going to want to see a strong dollar, right? Because with no exception, all big corrections in equities have been accompanied with a strong US dollar, a strong DXY. So that's one of the most important developments to look at. And I know many of the viewers on here are looking for such a correction, right? Because the markets are clearly showing signs of overextension, that they're going parabolic with excess optimism, excess bullish sentiment here. But all those developments only suggest the market is unhealthy, not that the market is going to turn around. So we still have to look at this as objectively as possible. Now, we also eventually expect a large correction to occur in the markets, right? There are two big narratives behind this rally that we're seeing. First of all, that we're seeing a big economic recovery, right, from the COVID-19, and we think that could not be farther from the truth. And I'm going to be discussing that in detail in one of the next premium episodes, where we're going to take a look at the full macro picture that we have right now, taking a look at public debt, taking a look at private debt, what type of environment we're in, and could we actually be seeing a huge economic recovery right now, or are we actually seeing a big dichotomy between the financial markets and the real economy? And I think it's the latter. Monetary policy since 2009 has been unable to really stimulate economic growth, but it has been able to stimulate assets. And that's what we're seeing right now. We're seeing the housing and stock market go up, but the underlying economy is lagging. So we believe that's going to create some price instability over the next few months, even over the next few years. If you're interested in finding out about what investment opportunities we're looking to protect ourselves in this environment and potentially take advantage of this situation massively, you can check out our website at gameoftrades.net. We're going to be talking about this subject a lot over the next couple of weeks, so make sure to tune in for all that. But back to what I was saying with the dollar, let's try to stay on track for this video. If you're expecting a large correction like we are, you have to be looking at the dollar, because as long as the dollar is heading down, it means investors believe that monetary policy is still able to push assets higher. And as long as we have a weak dollar, you're not going to see a market correction. So taking a look at that longer term picture of the US dollar, we did have a big breakdown here. So this is the channel that we're looking at. It's not perfect, but I think it does highlight the big developments we've had over the past few months. We were trading within this bull market range here on the DXY, bouncing up and down within this channel, right? Acting as support and resistance. And here in 2020, we had a significant test, then breakdown, then retest, rejection, right? So these were all bearish developments for the dollar. So that gives us a bearish bias from current levels. We've recently had a long-term breakdown. So, we wouldn't be expecting a massive leg up in the dollar following a rejection off a longer term resistance level like this. So we have a longer term bearish outlook on the dollar. And looking at this chart, the daily chart of the dollar, we also have, for now, a bearish outlook on the dollar, right? Lower highs here, significant lower highs. And so far, this high has also been a lower high relative to the previous one in March 2021. That's very important. If we begin to see a breakout here above this zone of resistance, above this line of resistance here at 93.5, that gives us a big change in character on the US dollar, because we have a low, a higher low, then a high, and a higher high. But that's not the case for now. For now, this is just a consolidation here following a large downtrend. Right? So when you have big periods of downtrends, you need price to consolidate for a while before it can resume that downtrend. And I think that's what we're still seeing right now, a consolidation in the dollar before heading further down. Again, that picture can still change, but right now it looks like that's what the charts are saying. This is the chart that we've been looking at over the past few videos, so I'm not going to spend too much time on it. But again, line of resistance here. We're testing it right now. It seemed like we were breaking out here, but it was very weak with weak momentum, no renewal of momentums. So a lack of conviction in this dollar strength that we're seeing right now. I'm seeing a lot of people on Twitter getting excited about this breakout, saying that, it's a inverse head and shoulder pattern. It could still be, right? It could still be, but we need a renewal of that momentum, taking out that high. That would make us flip to bullish. Right now, it's looking like a very bearish structure that we're seeing on DXY. So let's zoom in a little bit to what's going on here. The shorter term technicals, I always have less conviction with them, but here we have a nice primary uptrend line, and it seems like we're breaking down here, breaking back down below this line of resistance that was broken here, retested, and now we're making a type of false breakout right there. So, we'll see how it resolves itself, but it doesn't look too good for the dollar, which could be bullish for equities. Now, the reason we're taking a look at the 10-year yield is because of its massive correlation with equities. When you see the 10-year yield rally, it's suggesting that the economy is strong. There's a big correlation between yields and equities. You can see zooming out here, I've put up this indicator highlighting the correlation between the S&P 500 and the 10-year yield. Right, so when this indicator is above that zero line, it means the correlation is positive, meaning that when yields go up, stocks go up. When yields go down, stocks go down. So you can see in the majority of the time, there's a positive correlation between equities and the 10-year yield. And that makes sense because a rising 10-year yield suggests a strong economy. It also suggests that bond prices are falling. And if bond prices are falling, that suggests that more money is being allocated to stocks. So all of that means that when you see a rising yield, it tends to be good for the stock market. Now, in the last video, we talked about this move here potentially being a significant bottom in the 10-year yield. It was very controversial considering the recent breakdown we had. And I understand that. You can have your own convictions, make sure to leave them down below. There were a few very great comments talking about the case for lower yields. There's a lot of investors expecting deflation right now. So expecting yields to drop down all the way to, July levels, even lower, potentially down to zero. For now, that's not something we expect. You can see, for example, here, the price of copper. Copper is an economically sensitive metal. The price of copper doesn't go up in a deflationary environment. It goes down massively in a deflationary environment. In fact, if I add yields on top of this chart, let's zoom out here, you're going to see the massive correlation between copper and yields. As yields go down, copper goes down. As copper goes up, yields go up. In fact, here in 2018, you could have predicted that yields were going to top a few months later because of that big drop in copper, right? Huge market correction in copper, and just a few months later, big top in yields. Same thing, of course, during COVID, big drop in copper prices, big drop in yields. So huge correlation between copper and yields. And by the way, this is pure intermarket analysis, right? If you enjoy this type of content, make sure to smash that like button. We absolutely love taking a look at intermarket analysis to predict large market trends. So if you like that type of research and information and education, make sure to leave a comment down below, or smash the like button to let us know that you're enjoying it. So getting back to what I was saying, if you're a deflationist and you're expecting deflation right now, following this breakdown in yields that we just saw, then you would ideally want to see copper prices to be falling, right? But that's not the case. So we have to follow the charts that are in front of us. What are they saying? They're saying that copper is going up and that this massive leg up in copper is not over, and that we're still trending up, that potentially the economy is still stronger than some expect. Now, that doesn't mean that deflation is not going to come potentially later on. That's very possible, especially if the Federal Reserve begins to tighten later this year or early next year. That would most likely cause deflation. But this move in copper here is telling me that we may not be heading into deflation just yet. And if we're not heading into deflation just yet, perhaps yields are going to start trending up here. Maybe they're going to do a little bit of sideways action before completely bottoming, then see a rally. A rally in yields and a falling dollar would be good for equities. In terms of technical analysis, I can put some fib retracements here from the bottom of this move to the top of this move, and you'll see the 50 retracement level here corresponds exactly to the support level that we tagged right there. So 50 retracement level, that's a typical retracement level for a counter trend correction. So if we're currently trending up in yields, then this type of move is completely natural and 100% to be expected, right? So there's no big breakdown in trend just yet, even if we've seen this breakdown with the trend line. In terms of fib retracements, we're still in an uptrend. And I can show you an example of that. I showed you that in the last episode. I can measure the fib retracements from the bottom of this move to the top of this move, and you can see this counter trend correction almost tagged the 50 retracement level. It reversed a couple percentage points off that level. So for now, it could still be a similar situation to what we had in 2017. So that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, make sure to drop a like and subscribe to the channel if you haven't already. Now, in the meantime, good luck on your trading and see you next time.